to the Money Storm Show. This is a place of discussion about all things money and how to weather that financial storm. Without further ado, you have your hosts, Chet and Larry. You have Chaitanya Monga, otherwise known as Chet, the founder of Brightcap Financial, a commercial and alternative mortgage brokerage. You also have Larry Heron, the founder of City Center Mortgages, a mortgage brokerage which specializes in residential mortgages nationally.
Yes. Welcome back, everybody, to episode 8 here at the Money Storm Show. Chet, thank you for the introductions. As always, this episode we have another guest, so we're actually very excited about this guest. It just fits our brokerages so well. Chaitanya being in the commercial space, myself being in the residential space. We deal with a lot of lenders, and we deal with A lending, B lending, private lending. So in that space, in the private lending space, we've got a very special guest. Without further ado, I'd like to introduce Mr. Colin Johnston here with Vault Capital. And Vault Capital, I got
yes,
that right? Yes,
absolutely.
Awesome.
Yeah.
Wanted to actually just touch on Mr. Johnston's resume, which is super impressive. I've known him for a very long time. He is definitely a trendsetter in the industry, and someone who knows a lot of people and has, like I said, a very impressive resume. So I'm going to get into it. He started off about 10, 15 years ago as the director of HSBC Finance, where I actually worked once upon a time. We didn't cross paths, but we definitely knew of one another. And then moved on to becoming the director at Manulife One, right? So Manulife One, so huge right there. And then moved on to being the vice president at CHIP Home Equity Loans. So that's, CHIP is number one in Canada for reverse home mortgages, being a VP there, major status. And now he is a sales SVP at Vault Capital, who just moved into British Columbia, so sales vice president. Mr. Colin Johnston, welcome to our show, Money Storm Show.
Thank you, guys. Pleasure, guys. Looking forward to it. I wish I was only 15 years in the industry. You notice the gray beard. So I've been doing this for about 30 years. And I started out in the industry in this little company called TransCanada Credit that doesn't exist anymore. My very first finance job, got into it by accident and got a lot of exposure to alternative lending. I did want to get into the other part. So that's why I've done A lending, which is the Manulife Bank, mainstream lending, reverse mortgages, which I did 9 years, which I'm super passionate about. Great product. And with the aging population of Canada, we're going to become more important than ever. And then into private lending, where we just wanted to help a different group of people, super strong people. We want to offer a really good solution at a reasonable price. Because as everybody knows, the population is seeing it's super hard to qualify for bank mortgages now because of what the government's done to the rates. Yeah. So we help out super strong people at what we feel is a very fair rate, and allow them to stay in their home. Because there's a lot of people, especially in Ontario, who've been forced out of their houses because of this. We've been lucky in British Columbia because we didn't have the crazy appreciation that Ontario did, but a lot of people got put into houses last year that can't afford them anymore, and families are being forced out. And we want to help them stay in.
Absolutely. Thank you so much for breaking that down for us a little bit. So, Colin, your space in the finance industry in Canada is very unique. Yep. Just for the average consumer here, we want to say that there's 3 different branches of lending. There's the A, traditional lending, right, which is with standard banks in Canada. Then there's B lending, alternative lending, which is with some other lenders, almost bank style lending. Then there's the private lending side, right? You told us a very unique term the other day. You called it near B lending. Yeah. So maybe tell us a little bit about that and how you guys fit into that space, because it's a unique product.
It is, and we actually are trying to create a 4th category.
Got it.
Because there's 3 distinct. We're trying to create a 4th. And the reason we think there needs to be a 4th category, because private lending, you're going to see the TV commercials from the people over and over and over and over again that are trying to get people into these fast loans. I won't say their names, but you'll know.
Sometimes we see them on Super Bowl commercials, and stuff like that on the Canadian
stuff
side.
Like that. And if you ever happen to call one of those groups, super high interest rates, right, super high fees, and trying to sell people on it being a temporary solution.
Absolutely.
But it's a super expensive solution that takes people's home equity. So that's part of the traditional private.
Right.
Then there's the B. And you'll hear a lot about B, and there's companies like Home Trust, Equitable Bank, Community Trust, really good companies.
Absolutely, yeah.
But they are bound by OSFI regulations. And OSFI is really trying to make it, like, not on purpose. They're trying to cool the economy. They're trying to make sure people don't get into mortgages that they can't service. But it's become really, really, really hard for people to qualify for B lending.
Yeah.
So you have really strong people, and a lot of them are self-employed,
Right.
that declare an income in such a way it doesn't fit the bank. So they think they're going to go to the B space, and the B lenders are really hard on them too. So a lot of these people are getting pushed into these super expensive private. So we've created a category called near B.
Right.
I love it.
So
Near B fund.
near B.
Yeah.
And the difference is how we actually underwrite our clients is we actually will look at their bank statements. And if we can see that they can afford the payments by us looking at their cash flow, their deposits,
Right.
we qualify their income that way. We don't
It's
do a
simple
forensic audit.
reasonability
Yeah,
test,
it's a
right?
reasonability test. We don't do a forensic audit on
Right.
their tax returns, their business activities. We just reasonably do that. They demonstrate the ability to pay their bills by their strong credit record,
Right.
and they have good equity and a nice property. So those people should never be pushed to private, and that's what's been happening.
Yeah.
So at Vault, we wanted to come in, and we're trying to create this other category we call near B.
Absolutely.
So you've still got your disciplined underwriting,
Yeah.
but you've got the simple convenience
Mhm.
of your private underwriting,
Yeah.
less paperwork
Yeah.
based on that reasonability.
Well, and there was a
rates are
time-
nearing our B
Yeah.
lenders.
And, Larry, there was a time, and again, me doing this 30 years, where at banks and finance companies everywhere, we just applied common sense. We saw a strong client, we understood their business and their cash flow, and we would approve them. Government regulation came in 2016 with B20, and a lot more red tape has come in, and has made, so these people were all bank clients before. Then there was no stop in between. They're getting pushed into private. And we're just applying old school common sense underwriting to good people, and giving them a reasonably priced product.
Yeah.
That's awesome, Colin, that you come into this space because you've come into it in a timely fashion, because there's a high demand and high need for it
Yep.
right now, because the stress test that got rolled out in January of 2018, yeah, sure. It started to make sense about a few years later when a lot of my pre-approvals, and I feel like people out there got used to it and accustomed to it.
Yes.
And, now a couple of years later, they started buying again. Before the pandemic, there was activity
Yes.
because, and I was actually quite proud of it, to be quite honest. I was like, hey, the stress test is actually a good protectant for our overall economy.
It's a buffer.
It's a buffer, and now, and it's working out well. But now, that was in 2018, or sorry, 2020, I was saying that.
Yeah.
But now, it's a pain in the ass.
I think
Because this
that's a
2
fair
points
statement.
higher than the contract rate. Like, give me a break.
Yeah.
You're qualifying
Give
people at
Canadians a
8%.
break.
You're qualifying people at 8%.
Yeah, I was
Right.
going to make a joke and
Yeah.
say, like, 2
Yeah.
points higher than contract. What are we qualifying at? Like
Right.
17.99 now,
Yeah.
right?
Yeah.
It's absurd, and
Yeah.
Colin, it's frustrating, right? To mention, and I'm sure the
Yeah.
B lenders and
Mhm.
the Home Trust and the
Yeah.
Optimums and
Yeah.
the Equitable banks are also frustrated as well.
Well, they're all regulated by OSFI, so they have to play by that government rule book. And by the way, like our near B, we actually want to be a temporary stop for these super strong people when sanity returns to the mortgage space, that they have a soft landing at a cheaper mortgage, but not at the price that private's charging people right now. Right? Because
Let's chat a little bit about that, because
Yeah.
you said something about privates charging what they're charging right now.
Yeah.
So, we at a time not too long ago saw even private lenders or mix, right?
Yep.
Mortgage investment corporations offering rates at 6.25,
Yep.
6.49,
Yep.
7%, call it. Now those same rates are 10 plus,
Yep.
right? Why is that, Colin? Tell us a
Yeah.
little bit about that. You
Well-
broke it down for us a little bit before.
Well, so these MICs, which
Yeah.
again stands for Mortgage Investing Corporation,
Right.
great businesses, been in British Columbia a long time. In fact, British Columbia is where MICs actually started in Canada.
Is that right?
Yeah, they started in British Columbia. There's some companies out here that are more than 50 years old.
I would have guessed Ontario
I
or
would as well.
Alberta.
British Columbia is actually the home of the MIC. And
Home of the Mick. I love it.
so what they are doing, so they have two ways of raising capital.
Right.
Number one, they go to the public and they try to get them to invest in these funds, and they say that the risk is spread out over a bunch of mortgages, different houses, and it's super safe. The second way is they get lines of credits from banks. So that model worked. The second worked really well when prime was what was the lowest prime was, guys?
That was 245.
245. So again, they could afford to lend out at 6.25 if they're paying around prime or a little bit over prime for their money, because their profit was the spread, the difference between the 245 and the 6.25 they were lending out. And that worked super well until the Bank of Canada did their thing.
Yeah.
And now, just that same spread, let's just say for argument's sake, they need to be 3 or 4%. So with what prime is right now, that's why you're seeing these private lending rates in the tens.
Yeah.
Right? They have no choice. They're businesses. So they said, why don't we go back to the first way of raising capital, going to investors? Well, unfortunately, they did all of their mortgages in fixed rates. So they fixed all these rates. They locked their investors in at these low rates, but their cost of capital was floating.
Right.
So these MICs are only offering returns in the 6s or low 7s to people investing in private mortgages, which is higher risk.
Right.
An average person could go down to the bank and get a GIC for 5.5. So people are not going to take that risk for that little bit of extra return. So they can't get capital from the public, and their lines of credit are too expensive. So they've had to pause.
So that is speaking volumes for what's happening right now. You know, some mix out there are on pause. I guess they're using the same term that Bank of Canada used, but it's not a pause. It's depleted funds, and it's waiting for exits.
Well, then the other thing that's happening, so if they can't raise capital from the public, and it doesn't make sense to take money from lines of credit, where these MICs get their money from is getting paid out on mortgages so they can re-lend it to other people.
Right.
So there's this thing that's happened to the housing market is houses stop selling.
Yeah.
And the way that people pay out private mortgages traditionally is by selling their home. So they're not getting the money back. So there's some really, really great MICs out there that are still healthy, but they've stopped lending money because they don't have money to lend.
And your comment on the sale makes great sense because all the articles that we read that what was it again? About 50% of the homes in 2021 were investor based.
Yep.
And those were probably flippers and looking for sales.
Sure.
And now in 2022, sales aren't happening. They dramatically slowed down. They halted, and the private lenders were not getting the exits they anticipated.
Yeah.
So what do you think is happening now?
Well, what's happening now is most of these MICs are really hoping that the housing market is a lot better than 2024. So they're taking these clients, and unfortunately they have no choice. They're increasing the rates at the renewals because they need a bigger return than businesses. They can't afford to just to lose money because they're not losing just their money. Yeah. They're losing their investors' money.
Right.
So that's the bottom line.
They have to maintain the return for the investors to stay with them.
Precisely.
So
right
question.
now,
traditionally, upon renewal, a private lender always does not want to renew. They're in it for the short term, but if there is a renewal, regardless of today's market, good market, bad market, the renewals are always slightly higher regardless, right?
You know what, Vault, it's not. We can, our stuff is variable, so it's prime plus. So when the renewal comes up, the property's still good, the market's still solid, client's paying. If they were prime plus 1.5, they're prime plus 1.5 again at renewal.
Right. So their rate at the end of the day is probably going to be lower if prime is lower as a result.
Yeah, provided nothing crazy happens in the economy. But that's how we model it. We're not in the business. Like, we actually, the average private lending client doesn't actually exit in a year. They hope to. On average, it's a little bit more than a year, but it's less than 2. Right. So there is a lot of private clients who actually are exposed to renewal. And, we really are a super ethical, fair group. So we want to actually present a fair offer. There are privates out there, and I can't comment on their business models. They're making the renewal offers so high, they're hoping that people don't renew. Yep. They're hoping they go somewhere else and get paid out so they can get more money. So how they make their money the other side, if they're not doing new mortgages, they charge a lender fee all the time to the client who's borrowing the money. So if you're not lending out new money, you're not making lender fees. And that's the big profit center. So they actually want to get paid out. So they sometimes will present offers to people hoping that they go somewhere else. But again, with the property values doing what they did, where are they going to go? Right. So that's really, again, a challenge.
I mean, when it comes down to refinancing and that client exiting that specific mortgage itself, they have to requalify again with potential alternative lenders or lenders, get hit by the stress test and all these different policies that are in place. And then, of course, also look at the fact that their property may have depreciated.
Yep.
I mean, on a national scale, I think Canadian properties adjusted by 19% decrease.
Yep.
Right. So with that said, if a private lender had lent out at, say, 75% loan to value, and now the property price had depreciated 19%, there's only 6% of equity left. Right.
It's tough. And we do work really closely with the brokers that brought us the client in the first place.
Right.
With the renewal. So we actually make our brokers our partners.
Right.
And if the deal doesn't make sense for Vault anymore, then we work with the broker to help them exit somewhere else. And if they're staying, we want to make sure that the broker has a look at it to make sure that the offer we're doing is fair. Because we say we're fair, but really the client is not ours.
Right.
The client belongs to the mortgage broker that brought us in the first place, because the broker's fiduciary duty is to always find the best offer in the marketplace for their clients. So that's why, especially in the Ontario market, we very much include the brokers in our renewal process.
You know what? I really like that because, I think me and Larry can both speak on the fact that we've dealt with alternative lenders that will almost try to push brokers out of the renewal because they don't, out of the renewal process. And what ends
to
up
the
happening,
punchline, sending out the renewal offers about 5 months in advance, 6 months in advance. And these are,
the typically higher rates we've realized, right? So when a broker gets involved, we have the experience to back it up and fight with the lender to get more attractive rates.
Yeah.
And the lenders, of course, going to try to squeeze us out if they can make more money on their initial investment.
The other topic we're seeing a lot of, and I know you two know a lot about this, especially you, Chet.
Yeah.
There's a lot of people that watched houses appreciate consistently, thought it would happen forever. So they decided to become property speculators and professional landlords. And we're seeing a lot of really average people owning 5, 6, 7, 8 houses.
Right.
With at least probably 75% of those being in private. And those are a problem right now.
Yeah.
Those are a big problem.
With no real estate portfolio experience, landlord experience. You're absolutely right.
Yeah.
We've seen a ton of that as well.
Yeah.
In the market of 2021 and that low rate environment, it's like everybody became a general contractor.
Yep.
A flipper. Everybody became a builder.
Yep.
Everybody became a professional real estate investor.
Yep.
Like if you sold in, the peak there, what it's classified as, December to like May, you just timed it, right?
Yep.
You got lucky, right? But now that actual person thinks he is a real estate guru, right? Like I am. I know how to time things, and I'm that.
Yeah.
And it got in people's heads, and they continue to make.
Yeah, they watched an infomercial at 2 a.m. and they figured it all out, and they became a landlord and a speculator.
Absolutely.
And I've seen this before. Getting the gray beard, I was in this business at HSBC in 2008.
And that's why I said 15 years. So thank you for letting me know 30 years. It makes me feel a whole lot younger.
That's okay.
I didn't know who they were.
Yeah.
So I know you've been in it for 30 years, but I started at when I got in.
So for anybody watching this, it's really hard business. I'm actually 32.
I feel young.
Yeah, I'm actually 32. It's just a really hard business. I'm kidding. I'm 54. But we saw this in
It's not hard business. The last 2 years put on all the grades, including mine. Thanks, Bank of Canada.
Yeah. Well, Larry and I had full heads of hair before, and then it all changed.
We should bill it to Bank of Canada, and we all fly out to Turkey, right?
At least you have hair.
So you've heard me sort of venting and complaining about government regulation, but I want to tell you, in 2008, our banking system saved us when our neighbors to the south went down hard.
Absolutely.
And
I say this all the time.
Yeah.
I'm sorry to cut you off.
Yeah, no, and I can tell you, as much as I was actually a fan of the stress test like you, Larry, and I remain a fan of the stress test because we do need something to protect ourselves from ourselves.
Absolutely.
Right? So this too will pass.
I'm in it for the long haul. Like I'm in the mortgage industry for the long haul, big advocate for it, and I want it to survive. I want to pass on knowledge, and the stress test was good. But right now, like there should have been a cap, right?
Well, I think the government acted too late when they saw this fire happening in the market a year and a half ago. They should have done something to cool it.
Absolutely.
But they were loving all the tax dollars they were making from all of the sales because it's a great revenue source. And ultimately, anybody who's an economist could have known that we were going to have an affordability crisis.
It was even us, like being on the sidelines. Where friends are developing homes. And I was a part of some pre-cons and stuff like that.
Mm-hmm.
And I saw the elevation of prices month to month.
Yeah.
And I was like, this is not normal. This is absurd. I was talking to chat
It
as
was
well.
a
Like,
concern,
I bought
absolutely,
a
yeah.
home in January, and
Yeah.
like a client buys a townhome in January for 800, and then in May that same square feet, same plan was 949. You know, January, and then I was like, this is something's up here. I'm like, you know, this is bad. Point of the story is, we're seeing this on a month-to-month basis. Bank of Canada, the government officials that are sitting there watching this on a supposedly minute-to-minute basis. I do not see it.
Well, you know,
If we
and
saw it on
again, I've, you know, there's an economist named Benjamin Tall, who
Yeah, I
I think
follow him on Twitter.
from CIBC. He's the guy that I actually follow, that
Right.
I actually think has this pretty much figured out. And he said the government's number one concern and only concern is cooling inflation. They actually don't care if they have to kill the housing market to
Right.
cool inflation. So unfortunately, their plan has worked. But here's a funny one. I watch Global News and they talk about, well, all of a sudden there's an affordability crisis for renters. Well, of course there is. Their landlords' carrying costs have gone up by 50%.
Significantly, yeah.
Do they think that that's for free? So of course the landlord has to pay that on to the
Absolutely.
renter.
At the end of
right?
the day, the payment or the
Yeah.
mortgage payment is,
Yeah.
of course, going to impact the tenants that
Yeah.
are in that property itself. When
Yeah.
your mortgage payment went from being $3,000 a month to
Yeah.
now almost $6,000 a month,
Right.
how could you think that's not going to have a reaction?
And I'm surprised that it's like the government's acting surprised that that's happened. It's an
Right.
obvious ripple effect. This isn't just a crisis of homeowners. This
Right.
is a crisis of renters too.
Yeah.
Because again, the like you said, the cost to carry a house is way more expensive, and they have to pass it on.
Absolutely.
The spotlight is on Canadian housing,
Yeah.
bubble, the shortage,
Yeah.
affordability.
Right.
Everything is like a crisis. For
Yeah.
sure.
Yeah, but back to private lending,
Yeah.
Larry. I think that when clients are working with a mortgage broker, they need to make sure that they talk really closely with the mortgage broker about, if you're going into a private or an alt lender like me, to work really close with the broker to say, what is the plan to bridge me to something cheaper and better? And if your broker doesn't actually have that for you, you should probably talk to a different broker.
Absolutely.
Because we are, and we've always intended to be, a 1 to 2 year solution to bridge somebody
Absolutely.
to a better product.
I'm calling just to touch on that.
Yeah.
Me getting my clients into private financing is there's either a financial gain if it's consolidation
Yep.
or whatnot. That just
Yep.
speaks for itself. 20% credit cards, whatever. You're
Yep.
bringing it down. But any private, for that matter, I'm always a little bit like there's a feeling in myself a little bit fearful.
Yep.
Right, a little bit fearful for my client, and
Absolutely.
if the brokers are not slightly like not fearful in a way where it's just like having that respect for the client that you're getting them into private. What's your plan? It's your responsibility to get them out, have the
Yep.
discussion.
Yep.
If you don't have those feelings as a broker, then
Mhm.
which a lot of brokers do have, there is cutthroat brokers
Yep.
out there. And
For sure.
Win it, make money. See
Every
you later.
every profession.
There's a
do
ton
that.
of that
Yeah.
in BC and Ontario, and that's sad.
And
That sucks. What do you guys do with files like that?
Yeah, it's funny you say that. So every file I get, I have to understand and believe the exit plan. If I actually don't understand the exit plan and I don't believe it, I have a hard talk with the broker.
Our deal notes always have exit plans. It's at the top. Here's the exit.
Yeah.
You're still getting files and submissions that don't have exit plans.
They always have exit plans, but I don't believe them. And
Right.
I'll take you
Generic
back
ones.
because we've all been in the business a long time. So you talked about me working in reverse mortgages. When I did reverse mortgages, I talked more seniors out of reverse mortgages because it was the wrong product for them than I did. Because we have a responsibility as professionals, but human beings, to make sure we're putting the right product in front of the right person. And if it's wrong, maybe sometimes they actually really just do need to sell that house and get to a smaller one, a cheaper one. And I had that talk with lots of people. So back to the exit plans, I'm nice about it, but I can tell that some brokers just put a generic, we're going to a bank next year.
Yeah.
And I'm looking at the person's credit or I'm looking at their
Yeah.
income.
Like,
And I'm
how?
going, they're not.
Yeah.
And I have actually declined files because I did not believe the exit.
Yeah.
Because I was not going to cause a problem. Because behind every file, there's a family.
Yeah.
And when you're doing that, the financial transaction is you could damage families if you're not careful. So we all have a responsibility to do the right thing.
And I think
Yeah,
that's
we
where
all do, yeah.
good brokers come in, and the differentiation is about relationships over transactions.
Yes.
Right?
Yeah.
The relationships with the clients and relationships with lenders and all that stuff, vice versa, play more hand in hand than a transaction will ever bring you.
Treating
Yeah.
the client with dignity.
Yeah, and at the end of the day, like having a plan for them, they're coming to you for a reason. You're the advisor, right? So you should have a plan in place.
Speaking about this, Pierre, I have a little topic I want to talk about, but it looks like you have something on your mind here.
No, I'm just going to say that, if anybody sees this podcast and Google's Vault, don't call me. Okay, I
Don't search
want-
Google
don't
don't Google Colin Johnston and,
Right.
and call him.
because I really do need you to deal with a professional like Larry first, to go through the options in the marketplace
Absolutely.
to make sure I'm the appropriate one. I'm the lender, but I rely on my broker partners to get to know you as the client and to make sure we're the appropriate solution with a plan to move on to something better like we're talking about. But go ahead, Larry. What's
Yeah,
your
absolutely.
next one?
that's awesome. Appreciate that. You know,
Yeah.
that feedback right there, Colin. It's just good to speak to you at this level, like at a personal level.
Mhm.
You know, you being representing such a large fund and private lender, being the underwriter yourself, approving your files,
Mhm.
and just to know where your heart is at
Mhm.
and how you are still connecting with humans and not just being transactional, like
Yeah.
Chad said.
Yeah.
It's really good to know because this is our industry, right?
Yep.
This is our industry, and we're in it to win it. So that's awesome. Oh, what I want to get into is you said most exits are sales, right?
Yep.
And I know you are, majority of the business being done in Ontario or whatnot.
Mhm.
Now, from my book of business,
Mhm.
a lot of my alternative business, like B lenders that I have done with
Mhm.
Home Trust and Equitables, with Mules coming up now,
Mhm.
were not just sales. It
Yeah.
was that, hey, a lot of accounting plans. You're 1 year in, you got to
Yep.
do second year accounting. Once
Yeah.
your 2-year average is up, we'll get you over to the bank.
Yep.
So there was a lot of that in British Columbia, especially for my book of business.
And,
right?
and there, that's what
Yeah.
makes you the exception, not the rule.
Right.
Right, and that's why we dig into those exit
Yeah.
plans, because one more time, like I again, doing this for 30 years, I can look at somebody's income quickly, their credit, and I actually can know whether an exit is possible in a year. I know right away.
Yeah.
Yeah.
It's super obvious to me, and
Yeah.
and I'm still polite to my broker partner, but I challenge them a little bit. And I said, I really just want to make sure that you're setting this client up for success, because ultimately, sometimes a sale is a good exit plan. People get lots of equity; they're happy to get a different
Or
place.
sadly, the only one.
But
Yeah.
there's people sometimes that are being forced to sell homes that they never wanted to leave, and that is not good.
The
Absolutely.
heartbreaker. That's not
Yeah.
good.
Yeah.
Yeah.
I
That
think
is not good. We hate that.
I think me and Larry can both say that we've worked with clients that we brought into the industry through maybe the private channel,
Yeah.
worked them up to alternate, and then took them from alternate all the way to the A side,
Yeah.
and place them at banks.
That's
Those
because
are our proudest days. I
Yeah.
have
Victory.
many stories.
That's victory.
Private, B, A,
Yeah. Yeah.
550 Beacon, 650, 750, etc.
Yeah.
Right?
Yeah.
And that's why I brought this topic up, because the stress test and these rates are making that part challenging.
oh sure,
Right.
And it's heartbreaking for our consumers out there.
Right.
A lot of people out there. So what's happening is, you took an alternative mortgage and you took it at 2.64%, 3.64%, or 4%. That's what the B rates were.
Yep.
And now, you're coming out of a B mortgage or a private mortgage at these 5 to 7% rates.
Yep.
You're being offered the same rates.
Yeah.
There's no reward. So there was a time where people would be like, all right, you know what, just another year and we'll move on to the institution.
They
we'll
were
move on to the
motivated,
A lenders. And now they're coming into the A lenders and like, whoa, it's 629 there.
Right.
Or it's 5.5 there as well, or
Yeah.
higher.
Yeah.
Right. And now, some of the B lenders that they're
Yep.
reviewing with, or the A's, are not getting approved because
Mhm.
they got out-qualified. Back
Yep.
to that 2-point stress test. If I'm qualifying someone on Scotiabank's 1 year, 6.29, it's an 8.29 qualifying rate.
Yep.
My exit got messed up because my calculations were, done, from low rate environment or whatnot. So now they have to get renewed again.
Yep.
And, these folks are awesome for your near B fund.
They are, because there are people that are like on the verge of bankruptcy, bad credit, need consolidation. There's private lenders out there to help those people.
Right.
It's not what I do though. I really am looking for that really strong client.
Yeah.
And they said more times than not, they are self-employed.
Especially
And
here in BC.
in
Super
BC,
common.
and really they don't, not that anybody deserves to be private, but sometimes people are private just because of how they paid their credit and they have to prove themselves to a bank again. I just don't think these strong business owners belong on a traditional private desk.
Absolutely.
I don't, and that's who we're looking to help.
Yeah. Same with us, because a lot of good income earners, hard workers, blue collar workers, right? White collar workers, I feel got pressured into buying homes, investing, growing their portfolio, and now are one too many houses.
Yep.
Right. That second one might be too much. That third one might be too much.
Yep.
And some of them should be selling, but
Yeah, and they were just sold the dream, guys, as you're aware. They were just sold this dream.
It was that FOMO, right?
Yeah.
Everyone had it at a specific time, right?
Yep.
And everyone was buying. There was these multiple offers, that insane rush that people were having from purchasing properties and treating them like candy, right? And unfortunately, we're in the real world, right? And now this is where it's really getting tested.
Yeah, for sure.
No. So here's just my opinion, guys. I think we are in a bit of a temporary moment in time. That in about a year and a half, rates will normalize, but I want to define what I mean normalize. The days of 1.99 mortgages will never return.
Yeah.
That was an artificial environment that a lot of people, especially the younger people, thought were normal mortgage rates. An old guy like me actually thinks a normal mortgage rate is probably in the fours, maybe high threes and fours. And again, I think in 2024, we likely, unless something else unexpected happens in the economy, I think that's going to be the new normal and probably where it should be.
Yeah, we agree. We actually have the same discussion as well.
Yeah, we have the same discussion multiple times, and we strongly believe that the average mortgage rate should be near the fours.
Yeah.
Right. At the end of the
Canadians
day,
are spoiled.
Yeah.
Low rate environment, spoiled environment, and the rest of the world was already at 3.5, 4 when we were at twos.
Yeah.
And that's good investor money. Always has been. Always will be 4%. And if you take $1 million mortgages right now at 4%, that will have a $4,000, $4,500 payment. On $1 million bucks, that rent is going to be about $4,500 as well.
Yeah.
So that does the trick right there. So that 4% money is good money.
Yeah.
Definitely agree. Any other questions for our special guest here?
Special.
Definitely.
Definitely.
I want to just make a little announcement. Brokers, we have a lot of mortgage brokers,
Yeah.
obviously in our industry that hopefully are listening in right now. Guys, there's alternative mortgages that you might have, or private mortgages that are coming up for renewal in the 9s or the 10s. Volt's Near B fund should be really looked at if your client does not want to sell that house, or if that private MIC 10.5, 11.5 rate is too high. The alternative rate at 8.5 is too high. And if you've got good loan to value, Colin at Volt has a really super cool fund that's offering pretty competitive money. And if you want to save your clients your home.
And this money that we're talking about for Near B is not MIC money. It's actually institutional money. So my cost of capital is lower. We pass that on to our brokers and consumers. Right. And for the brokers, most files, I can actually tell you what the price would be and whether I can approve it in 3 minutes or less on the phone. Right. Because we know exactly where we fit. We have a really specific niche. We're the best at it. Yeah. And, we're growing in BC very quickly, and we're already huge in Ontario.
Absolutely.
Yeah, let's talk more about Volt. I mean, your footprint in Ontario. I mean, how long have you guys been out there, and what was your
10 years? We're also in the leasing business.
Right.
We also have a commercial lending business. We have a small business loans business and our mortgage business. So financial services, we cover an awful lot. They've been around for 10 years and originated over $1 billion in mortgages last year.
Wow. 10 years is actually a short time for that amount of success.
It is, but this business was built differently. Rather than, the cumbersome way of building a MIC that took 50 years to grow, we just chose to get capital somewhere different and go into a space that was a little bit different than everybody else. Rather than go into the rugby scrum that everybody else was doing, we wanted to be different on purpose. That's why we come to British Columbia, because there just isn't anybody that does business exactly the same way that we do.
There truly isn't. We work with tons of MICs and other lenders, alternative lenders, and the way Vault does the underwriting and takes a look at the file is significantly different, and of course a much cheaper option compared to those private lenders or MICs out there as well.
I love Volt's human touch, and you guys care.
Yeah.
There's nothing predatory here. No high rates. Nothing upon renewal. Fees aren't getting charged.
Yeah.
Surprise fees because the client can't exit.
Yeah.
Right. But you touched on that actually. Where MICs are kind of forced to charge renewals. If a client is renewing with a MIC, it's not the MIC's fault to charge a renewal fee right now. They're kind of forced to charge. And why is that happening? Because a lot of people are privates.
Well, because they have buildings to pay for, they have employees to pay, and they have investors to pay. They are a business.
Right.
And they are being forced right now, not their fault, to charge more on everything that they're doing. They have no choice. That's just the model. That's just what they have.
It's just good business, right? They gotta, at the end of the day, their cost of funds is a lot higher.
And you said something earlier, like everybody's notifying these clients fairly early on what the renewal is going to cost. So if they don't like the terms, they can go try to find better terms,
right?
Because like all the mix in British Columbia are very regulated, and I'm really proud that I work in this space in British Columbia. But 100%, they are very transparent. They're not giving the renewal like the day before, and saying take it or leave it, because they want to say, I'm really sorry, it's more expensive, right? And I hope you can find a better option. If you can't, we're here for you.
Yeah.
So I don't blame the mix for this at all.
Yeah, I mean,
absolutely.
Business is business. You have to do what you got to do, right?
Yeah.
And that one final topic I guess we could talk about is the MIC topic and the mortgages that were acquired in 2022. And since then, or the high market 2021, 2022, a lot of renewals that are coming up right now. Homes are underwater, amortizations are at 40 to 50%.
Yep.
The banks from the institutional side, the big 5 Canadian banks, and even our mix and B lenders and stuff, there's a lot of renewing going on, aggressive renewing, because on new money they have to charge again to keep the lights on. But there's a term that I heard on one of my favorite podcasts, the Looney Hour. Give them a shout out. And Steve Soretsky, a realtor in Vancouver, said that Canada is extending and pretending.
Kicking the problem down the road,
extending down the road.
And the problem is that these people, if they applied for this mortgage today because of what the home's actually worth in the real world, wouldn't qualify for this private mortgage anymore. Yeah. So these privates have two choices. They can call these mortgages and force these people to sell, which would be a glut of houses on the market at the same time they would drive it down, or just renew and hope that 2024 looks a lot better. And it really looks like the majority of people are hoping that 2024 is going to look a lot better.
Yeah.
I mean, this spring market is picking up pretty nicely.
Yeah, we sure hope so, right?
Yeah.
Talking with the realtor the other day, just in the Fraser Valley market here in Surrey, Abbotsford, Fraser Valley board. There's already 1,200 to 1,300 sales in Fraser Valley board in March.
Well,
with a few days still remaining.
Well, and I'm sure that person from the other podcast probably told you. There's been a big subset of people sitting on the sideline waiting to buy houses because they thought that the market was going to crash in Vancouver. Newsflash, didn't. Right? And it's spring market, so now they need a place to live, so they're going to buy.
There's pent up demand there for sure, right? We have clients that have been trying to purchase for a very long time, right? And have been the type of clients that are like, okay, they want to time the market.
Yep.
But unfortunately, you cannot time any market, right? And we know that being in the industry, it's not possible.
Well, we live in Vancouver. It's a great place. It's a great place to live, and people will always want to live here. And the huge immigration number you're seeing. It's not like people are immigrating and saying, "I want to live in Saskatoon."
Right.
They want to live in Toronto or Vancouver.
Yeah.
So we will always have this demand.
Right.
And we will always have a shortage of demand, and hopefully that bodes well for us.
Absolutely.
Yeah. I think we're going to come out of it pretty nicely. Like you said, the spring market's off to a good start. 2024, hopefully the values catch up again. People refinance, rates are lower, and all your credit cards and all your problems go away.
Absolutely. Yeah. That's sure hope for it.
Well, closing comments. Colin, thank you very much for joining us.
Thank you.
That was a lot of information. We'd love to have you again. And, guys, please remember everything discussed during these episodes, not financial advice, just financial information to educate you guys, the consumer, drawn from our personal and business experiences. If you have any specific questions about your financial situation, please contact Brightcap Financial or City Center Mortgages. Contact info can be found in the description below. And thank you again for tuning in, guys. Please, all we ask is share, subscribe, and post a comment. Give us some feedback, and we get back to all of our emails.
Absolutely. Yeah. Okay. Thank you, guys.
Thanks, guys.
Soon.
Appreciate it, guys.
Thanks,
Colin.
Colin.
Thank you.
Appreciate
Have a
it.
great day,
Okay, guys.